This screencast is looking at Summer 16 question 3, which is focused particularly on working capital management. Now, this is a very good question of the examiner style in recent years of applied style questions. So you're asked for 3 particular requirements here. Calculate the investment in working capital made by Cormac and its industry in 2015, and watch the and briefly comment on the result. So 7 marks. Then calculate the effective cost of accepting a discount for early payment. And then finally, have a more narrative piece about trade payable management, and to discuss a particular statement for 5 marks. So what you'll notice particularly about this one is there's 10 marks for calculations, but particularly the first calculation here caught a lot of students out. Traditionally, when we talk about working capital and working capital investment and cycles, we're given the figures for receivables, payables and inventory, and we're asked to work into the number of days. So I've given you kind of the formulas we have here. So you're typically given trade receivables, you'll be given sales, or if you have credit sales, you can use them. You divide one by the other, multiply by 365, that gives you trade receivable days. In 2016, the examiner worked backwards. So the examiner said a number of times they like these applied style questions. They're still asking you the same formula, which you need to know, because it's not in the notes, or it's not given on the day of the exam, but you're asked to work backwards. So what they're actually asking you is what's the monetary figure in receivables, payables and inventory for both Cormac and the industry average. And how you go about that is you use this formula, but you're working backwards. So if we start with A, I'm assuming you've read through the question, so if not, pause it and read down through it. We're going to work back for Cormac. And we're going to figure out how much is in trade receivables, how much is in trade payables, how much is in inventory. And how we do that is we use the formula that we have up here, but we're working backwards. So for example, we know trade receivable days, receivable collection days is 23. So we just say 23 equals, and then this formula will be X, which is what we want to know, our trade receivables. Our credit sales, we're told all sales are on credit, so that is 2.5 million times 365. And that is our formula. So let's put that over to make it look a bit better. So we're saying something divided by 2.5 million times 365 is 23. And all you do then is your junior cert maths, you work across. So you'll say it's 23. You'll multiply by 2.5 million to bring the 2.5 million across. And you'll divide by 365 to get your X. So your X then is about 157,000 euro. Let's put that there. So once you have the formula, all you're doing is working across. You multiply both sides by 2.5 million. That gets rid of that. So this is 23 times 2.5 million divided by 365. So that means our trade receivables, which is our X, is equal to 157,500 euro. So that was tricky, but what the examiner is trying to get away from is students rote learning formula and just really repeating in the exam. So this is working back instead of working from a euro figure to a days, you're working from days backwards. So it's a good example. Same example here. So we'll bring this down. You have 23 days again is the payable days, and this time it's X divided by, sometimes we use cost of sales, but in this instance we're given what the credit purchases are, so that's more accurate. So it's 450,000, and we're told assume 365 days in the year. So therefore our trade payables is going to work out as 23. We multiply by 450 to bring it across. We divide by 365 to bring it across. So our trade payables here will be about 28,356. That's what our trade payables are. 28,356. And of course, if you want to go back now and do your normal way, you have your trade payables, you have your credit purchases, you can work back and make sure it comes to around 23 days, just to double check your approach. There may be slightly off with rounding, but don't worry about that. Final one then is inventory, and we're saying it's 27 days. So 27 equals inventory, which we're trying to find out. For inventory, we always use cost of sales. So you never use credit purchases if you have it, because inventory is more related to cost of sales, times 365. An exact same approach as before. Our inventory then, as we work back along with your basic computation, is 27 times 750,000 times, or divided by, should I say, 365. So your inventory then is about 55,500. 55,479. Right. So that was tricky. A lot of students got caught that year, but it is important. You know, you don't learn off things. You need to look at the applied style. And we look at other questions as well. This examiner in the last 2 or 3 years has got very applied. At least one question will put a twist on the requirements. The twist here was you're working backwards with the formula. You're not working towards days, you're working towards numbers. Now just be careful, you have to answer what exactly was asked. You're asked for the investment in working capital. So that's technically not given to us. The investment in working capital is, let's bring this across a small bit, is the inventory plus the trade receivables minus the trade payables. That's what your net investment in working capital is. Adding the two current assets, take away the current liability. So the net investment in working capital by Cormac in 2015 was 184,184. Right, so that was tricky. What I want you to do now is pause the screencast and repeat this for your industry average. So repeat it for the industry average. See, can you come to the answer? You're looking for 4 figures again, all in euros. Right, so assuming you've paused it and tried it yourself, let's look at the industry. So we'll just do the industry here beside it. So I'll come over another one for trade receivables, trade payables, and inventory. So again, we're just doing out the formula just to practice it again. We know trade receivable days are 20 in the industry. Just put this alignment over. And we know that formula is gotten by some trade receivable over 3.1 million. Because be careful now, you're using the industry average revenue times 365. So your trade receivables then you can back into by saying it's 20 times 3.1 million divided by 365. So it's about 169,000. 169,000 for trade receivables for the industry average. All right. So we'll just repeat it for the other two. The payables is 43. And it's X over, for payables you're using the 625, which is credit purchases, times 365. Your total credit purchases there for the industry. So it's 43 times 625 divided by 365. So your trade payables then are about, and remember we do have to comment on this at the end, so we'll come back to it, about 73. About 73,630. And finally then, your inventory is 34 days. Just make sure they're the same format. And that is going from inventory divided by cost of sales, which is 950 for the industry. Just make sure you take the right one, times 365. So this is 34 times 950, when you multiply across, divided by 365. So your average inventory in euro figures invested for the industry is 88,493. So again, you're muchly repeating what you've done for Cormac in a separate one. You're probably looking for a mark each for Cormac, a mark each for the industry, which is 6 marks, and a brief comment then will get you your 7th mark. So in terms of the investment in working capital, how we calculate it for Cormac, we'll do the same for the industry. It's inventory plus trade receivable minus trade payable. So your inventory investment is 184,726. So the hardest thing there was to figure how am I going to use the formulas I had based on what they're asking. They may not spoon feed you in terms of directly applying the formula. You may have to work back. And that's the style of this examiner, and they've said that they're going to use that in the future as well. And so in terms of a brief comment to get your full marks, well, what we're seeing here, if we bring it back and we just try and see what's going on, well, both trade receivables and inventory, Cormac is more efficient. It has less money tied up in trade receivables and inventory, but it's getting a lot less credit terms than trade payables. So we can see the payables terms we're getting is 23 days for Cormac, but the industry average is 43. So it suggests we're a bit less inefficient there. So overall, we still have the same amount of money tied up, but it's just we probably need to examine our trade payables more as to why we're so out of the league of the industry average. Is it that we're paying on time and the industry is struggling, or that we're not being savvy enough with our negotiations with our suppliers? Because the more trade payable days we can get, the more valuable it is to us, because it's a valuable source of finance. Right. So if we look what the examiner said in terms of feedback that year, so on to page 23. So in question 3, the feedback was required to calculate. Many candidates scored full marks in this, but some struggled really with calculation. So again, some students figured out exactly what was required, but a lot of others didn't know. And that's where they hadn't practiced this applied style question, they'd learned it off. All right. The next requirement is asking you to calculate the effective cost of the discount and whether or not you feel it's worthwhile. So there's 2 separate things here, and watch that and. Calculate is probably 2 marks, and comment on whether you feel the discount is worthwhile or not. So you're told here they normally paid suppliers in 23 days, but the suppliers offered to give a discount of 0.75% if they pay in 5 days. So if they pay 18 days earlier, they get a 0.75% discount. And their current cost of funds, which is probably their overdraft rate, is 16%. Now this is answered very poorly, and I think a lot of students didn't realise this formula is actually given to you in the exam. So if we go to the end, just bear with me a second and I'll find it. If we go to the end, what you'll be given on the day of the exam, in terms of your formulas, the very last formula given is the annualized cost of a discount. This works regardless of whether it's the discount received from a supplier or a discount provided to a customer. So you get the discount, which in our case is 0.0075, because it's 0.75%, so watch your zeros there in decimals. You then divide that by, or if we want to do it here, it's probably easier, what we'll do is 0.75. So we'll do 0.75, 0.75%, we'll do it in full figures. It's 100 minus 0.75. Just be careful, because if you did that, you'd have to use 1 if we went the other way. So just be careful with your decimals and how you use them. And that is going to be times, I'll bring that just to show the formula, 365 divided by 23 minus 5, which is your reduction in inventory days, which is 18. So that formula was given, and a lot of students didn't realise that in the exam, and they didn't score well. So the true annual cost of that discount, if we do it out, is 0.75 divided by 99.25 times 365 over the difference there, which is 18. This is what it tells us the true annual cost of receiving this discount, because this is what we're getting from our suppliers, is 15%, or just over 15%. Right? So that's telling us if we take this discount, it's worth 15.3% to us. But actually, remember, if we take the discount and we pay 18 days early, that's going to have to be funded out of our overdraft, which is costing us 16%. So in that regard, it doesn't make sense. It's costing us more to fund the early payment than the value we're getting. So therefore, they should not avail of the discount. So probably 2 marks for doing the calculation, 1 mark for recommendation. That's your 3 marks. If we look at the feedback, very poorly answered, which is surprising given the formula was in the formula tables. So that again is to suggest you need to know what's in those formula tables and what's not. Ratio formulas are not in there, but a lot of the other calculations for working capital and for WACC, etc. are. So a bit of practice goes a long way. And last but not least, for 5 marks, which remember, if you're being strategic, you should have started with the 5 marker first. Get C done. Guarantee your marks, because if you run over time here, then at least you'll have the 5 marks on the board. If you start here and you struggle, you may not have time to finish those. So that's about exam technique, where to start. You could have even done C, then B, and then do A. Just manage your time and be strategic of which questions you do first. Alright, so although this is a narrative type question, it was more applied in its thinking. It asks you, fostering a strong credit reputation is an important policy of a company should have in the management of trade payables. So this means you should foster or develop your own strong credit reputation, and you're going to discuss this statement. So what you're looking for is 5 solid points. Why is it important to develop a strong credit reputation? This is the same as if it's personal finance. Right? You want to be known to be able to pay your debts on time. So the point you might argue here is you'd agree with the statement to say that's very important because trade payables is a very valuable source of finance. Right? And without it, it can make it very difficult to operate your business. Right? How do you foster a strong credit reputation? Will you ensure you pay your bills on time? You ensure you have an organized trade payables department. So you're not always saying, oh, I didn't get that invoice in. You always make sure, I know I have to pay by this date. I know that's the agreed terms. Right? You ensure you manage your credit rating. So everyone has a credit rating, as does every business. You manage that proactively. You make sure it's strong. You make sure to see how you improve it. Another important one might be you ensure you file your financial statements. You ensure you file your tax returns on time. Because otherwise that'll give you a black mark against your name. Because you're filing late for tax returns or filing late company office returns, which any prospective trade supplier will look up, and that will damage your ability to get trade credit. So again, it is very valuable, and if you have a strong credit reputation, you might get longer terms. So they might agree to give you more credit because you're less likely not to pay, and you might always be entitled to discounts. So it's always good. It develops a good relationship with your supplier. So what you're looking for is, it's applied in nature. It's not just a list off of bullets. And you have to give probably about 5 solid points to get your 5 marks. Where I said you could have started there to manage your time effectively. So that was Summer 16 question 3, looking at working capital management. And it's an applied style question, which is a favourite with this examiner.